Chapter 11 homework. Number 2, sales tax. We are supposed to journalize the transaction for the sale and payment of the sales tax to the state. Alright, so July 5th. On July 5th, Williams Company recorded sales of merchandise inventory on account $55,000. Sales tax were subject, the sales were subject to sales tax of 4%. Alright, so on July 5th, I'm going to collect cash, and I'm going to have sales revenue, and I'm also going to have a credit to sales tax payable. Alright, the sales revenue is for the $55,000 amount of the sale. The sales tax is the $55,000 times the 4%. And the two just add up, and that's how much cash is collected from the customer. Now, it's a sales tax payable. It doesn't belong to you. You have to remit it onto somebody else. Sales tax payable is what they call a pass-through account. It just passes through your hands and on to somebody else. So on August the 15th, I'm going to remit it to the state. So I'm going to take it out of my sales tax payable, and the cash is going to go out the door for the $2,200. And that's it for number 2. All right, for number 3, it's unearned revenue. On June 1st, Hunting Man magazine collected cash of $63,000 on future annual subscriptions starting on July 1st. Journalize the transaction to record the collection of the cash on June 1st. So June 1st, we collected cash. We have not sent out the magazines yet, so it's unearned revenue. And you could put unearned subscription revenue if you like, which is what I'm going to do. And so these all stay lined up. I'm just going to move everything over. There. Like, journalize the transaction required December 31st, the magazine's year end, assuming no revenue earned has been recorded. Okay, so we did this on June 1st, and it's for an annual subscription. So starting on July 1st. So I started mailing them out July 1st, so I've mailed out 6 of them. So half of that $63,000 has been earned. So at December 31st, I need to take it out of unearned subscription revenue. Remember that unearned revenue is a liability, and now it's going down. And I'm transferring it over to subscription revenue. And it's going to be half of the $63,000. So 63,000 times 0.5, half of it. And that's it for number 3. All right, number 4, accounting for note payable. On December 31st of 2017, Franklin purchased $13,000 of merchandise inventory on a 1-year 9% note payable. Franklin uses a perpetual inventory system. Journalize the company's purchase of the merchandise inventory on December 31st of 2017. All right, so they bought merchandise inventory, so it's merchandise inventory, and they bought it with a note, so it's a credit to note payable for $13,000. And sometimes I put down here like the terms of the note. So it's a 1-year 9% note. Journalize the company's accrual of interest expense on June 30th of 2018, its fiscal year end. All right, so we have to accrue interest expense at year end because technically I owe it and I haven't paid it yet. So I'm going to have a debit to interest expense. I haven't paid it yet, so it's a credit to interest payable. And it's been a half of a year, January through June. So 13,000 times the 9% times 6 over 12 months. And then at the end of the year, December 31st of 2018, the note is due and I pay it. So I'm going to have another 6 months of interest. Don't really need to calculate it because the previous one was for 6 months. I'm also going to pay that interest payable. I'm going to pay the note payable. All right, the interest payable is this $585 is coming out. Note payable is for $13,000. And then cash out the door is going to be all of that added together.